If you've been watching the news lately, you've probably heard the announcement. No more tax on Social Security. And if you're retired or about to retire, I completely understand why that felt like a relief, maybe even a promise finally kept. But here's what I want to walk you through today, because I've been getting this question constantly in the comments. What does that actually mean for your monthly check? Because the answer is not what most people think. And some of you may have already discovered that the hard way. So today, I'm going to explain exactly what changed, what didn't change, and what you personally need to do based on your specific situation. No political spin, no outrage. Just the facts, clearly, calmly, and honestly. Let's start at the beginning. When politicians talk about no tax on Social Security, they're referring to a deduction, specifically a proposed deduction on your federal income tax return that would offset the Social Security income you report. Now, that sounds helpful, and in some cases, it is. But it is not the same as Social Security being tax-free, and that distinction matters enormously depending on how much income you have. Here's the system that has been in place since 1984, and this is the part that most people have never been clearly explained. Up to 85% of your Social Security benefit can be counted as taxable income. Not taxed at 85%. I want to be very clear about that. But up to 85% of your benefit can be included in your taxable income, and then taxed at whatever your normal income tax rate is. Whether that 85% kicks in depends on what the IRS calls your combined income. That's your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefit. If your combined income is below $25,000 as a single filer, or below $32,000 as a married couple, none of your Social Security is taxable, zero. If it's between $25,000 and $34,000 for singles, or $32,000 to $44,000 for married couples, then up to 50% of your benefit becomes taxable income. And if you're above those upper thresholds, up to 85% of your benefit becomes taxable income. Now here's the part that should make you pause. Those thresholds, $25,000, $34,000, $32,000, $44,000, have not been adjusted for inflation since 1984. Not once. In over 40 years. When those thresholds were set, they were designed so that only higher-income retirees would pay tax on their Social Security. But because they've never been updated, more and more middle-income retirees have been pulled into taxation every single year, simply because of inflation pushing up their income, their pension amounts, or their IRA distributions. This is sometimes called bracket creep, and it's been quietly increasing the tax burden on average retirees for 4 decades. So where does the new announcement fit into all of this? What's being proposed, or in some forms passed, is a deduction. You would be able to deduct a certain amount of Social Security income from your taxable income on your federal return. Think of it like this. If your combined income puts 85% of your benefit into taxable territory, a deduction reduces how much of that actually gets taxed. It doesn't eliminate the tax system. It doesn't change the thresholds. It doesn't repeal the 1983 law that made Social Security taxable in the first place. For some retirees, particularly those with modest income and modest benefits, this deduction could bring their tax bill down to zero, and that's genuinely good news for them. But for retirees with a pension, IRA distributions, part-time work income, or investment income, the deduction may only partially offset what they owe. They will still have a tax bill. And here's something almost no one is talking about. This is a federal change only. Your state may still tax Social Security income regardless of what happens at the federal level. 13 states currently tax Social Security benefits to some degree. If you live in one of those states, your state return is completely unaffected by this announcement. So when you hear no tax on Social Security, the more accurate statement for many retirees is Reduced federal tax on Social Security for some people, depending on their total income. That's not as simple a headline, but it's the truth. Let me walk you through 3 real scenarios so you can see exactly where you might fall. Scenario 1, Margaret, age 71, single, Social Security only. Margaret receives $1,650 per month in Social Security, about $19,800 per year. She has a small savings account but no pension, no IRA distributions, no investment income. Her combined income is well below $25,000. She has never paid tax on her Social Security, and she still won't. For Margaret, this announcement changes nothing, but she was already in a good position. Scenario 2, Robert and Linda, ages 74 and 72, married, combined Social Security plus Robert's pension. Together, they receive $3,200 per month in Social Security, $38,400 per year. Robert's pension adds another $22,000 annually. Their combined income lands them well above the $44,000 threshold. Currently, 85% of their Social Security, about $32,600, is included in their taxable income. With the new deduction, depending on its size and structure, they may be able to reduce that significantly, but they will likely still owe some federal tax, and they live in a state that taxes Social Security, so their state bill remains unchanged. Scenario 3. David, age 68, recently retired, Social Security plus IRA distributions. David receives $2,400 per month in Social Security and is drawing $3,000 per month from his traditional IRA to cover living expenses. His combined income is high enough that he's solidly in the 85% zone. The deduction helps him, but between his IRA distributions and his Social Security, he's still looking at a meaningful tax bill every April. In fact, his bigger tax issue isn't Social Security at all. It's the IRA distributions. And that's a conversation we need to have separately. The point is this: where you land depends entirely on your complete financial picture, not just your Social Security benefit. Everything. I want to be honest with you about something that rarely gets discussed in these conversations. The reason so many retirees feel blindsided by taxes on Social Security isn't just that the rules are complicated. It's that nobody sat down with them before retirement and walked through the full picture. Most people spent 30 or 40 years in the workforce thinking of Social Security as a guaranteed, clean, simple benefit. You paid in, you get it back, done. But the reality is that Social Security sits inside your overall income, and how it gets treated for tax purposes depends on everything else around it. Your pension, your IRA, your spouse's income, your investment accounts. All of it interacts. And here's what that means practically. The decisions you make in the years before you claim Social Security and in the early years of retirement before required minimum distributions kick in, those decisions have an enormous impact on how much of your benefit gets taxed. For example, if you have a large traditional IRA doing Roth conversions in your early retirement years, before RMDs start at age 73, can reduce your future taxable income significantly. That means less of your Social Security gets pulled into the taxable zone. If you're still working part-time and haven't claimed Social Security yet, waiting even 1 or 2 more years can increase your benefit and potentially change your tax situation in ways that more than offset the delay. And if you have a mix of taxable and non-taxable accounts, the order in which you draw from them matters. Drawing from a Roth IRA instead of a traditional IRA in a given year could keep your combined income below the threshold that triggers taxation on your Social Security. These are strategies. They require planning, and they're available to you, but only if you know they exist and act before it's too late. So let me give you something practical to walk away with. Step 1. Find out your combined income number. Add up your adjusted gross income, any tax-exempt interest, and half of your annual Social Security benefit. Compare that number to the thresholds I mentioned. That tells you exactly where you stand right now. Step 2. Check your state. Look up whether your state taxes Social Security. If you're in one of the 13 states that do, understand that your state return operates completely independently from whatever changes happen at the federal level. Step 3. If you're not yet retired or not yet claiming Social Security, run the numbers on timing. Every year you delay claiming past your full retirement age increases your benefit by 8%. That's guaranteed. And a higher benefit, claimed at the right time, combined with smart income planning, can make a significant difference in your lifetime tax picture. Step 4. If you have a traditional IRA and you're between 60 and 72, talk to someone about Roth conversions. I covered this in detail in a recent video. I'll link it in the description. The window between retirement and age 73, when RMDs begin, is often the best opportunity most people will ever have to reduce lifetime taxes, but it requires action during that window. Once RMDs start, your options narrow considerably. Step 5. Don't make decisions based on headlines. I know that sounds obvious, but I've seen too many people either panic or relax based on political announcements that don't actually apply to their specific situation. Your tax picture is personal. It depends on your numbers, your state, your income sources, and your timing. A general announcement, no matter how it's framed, cannot tell you what it means for your check specifically. Here's what I want you to take away from this. The announcement about no tax on Social Security is real, and for some retirees, it will genuinely help. But the full picture is more nuanced than the headline. The underlying tax structure hasn't been eliminated. The thresholds that have never kept pace with inflation are still there. And your individual situation, your income mix, your state, your account types, determines everything. The best thing you can do is understand your own numbers. Not someone else's, not a general example, yours. If you found this helpful, please leave a comment below telling me which scenario was closest to your situation, Margaret, Robert, and Linda, or David. It helps me understand what topics matter most to you so I can keep making videos that are actually useful. And if you haven't already, subscribe and turn on notifications. Next week, I'm going to walk through exactly how to calculate whether a Roth conversion makes sense for your situation, with real numbers, step by step. Take care of yourself, and I'll see you in the next one.